Alright, this video is to explain how this Excel spreadsheet works. This spreadsheet is called Personal Investment Calculator, and it's the one that you download from the Schoology page. Right here it is. When you click on it, you're going to have to hit this download button to download it to your computer. If you don't see this button, there's like a little dot here, a little option that says More. Click on that and then you'll see a download option. Then it downloads it right over here. You double click on it and then it should show up right here, so you have to click on it, and here we are. Now how this works is the yellow boxes are the ones that you can modify, that you change in order to give us the results, to give us the analysis of how much money we're going to have in our investment any given year. So it's going to do the calculations over here in all of these cells. All we have to do is type in the yellow, and then you can modify these, and I'll talk about these three here in just a minute. But first I want to talk about this column. So we're going to make a quick assumption. We're going to say that you just graduated, you're 18 years old, you graduated from high school, and you decided to work for the first year full-time. So maybe you're taking classes in the evenings or something like that, but you're working full-time, and you're getting minimum wage, let's say. So by the time you're 19, you've worked a full year now, and let's figure out what your salary for the year would be, based on, like it says here. I'm going to type $24,000 in there. And you're going to say, well, how did you calculate that, Mr. G? Because what I did was, here, I'll just go over here and I'll show you where I do the calculation. If you work 40 hours a week, that's a full-time job, and there's 52 weeks in a year. How many hours per year? Well, then we're just going to say equals. We're going to do a little formula here. Take this guy, multiplied times this cell, and we say, there's about 2,000 hours. We can round it down because most people take a little bit of time off, so they don't. So we're just going to say 50. And the reason I want to do that, I'll show you in a minute, is because then it's a nice even number. Because this is just an approximate we're trying to figure out. So how much do we make right now in the state of Colorado? Minimum wage is $12. At the time that I'm making this video, it's $12 an hour. So I type in 12 there. So 2,000 hours you work if you're full-time times 12. So let's do a little quick formula. Oop, did that one wrong. There we go. And it's 24,000, and that's where I came up with this number of 24,000. Now, if you follow this advice, my advice, and the rule of thumb in investing is to put away at least 10% of every dollar that you earn throughout your working life. By the time you're 60, you'll be a millionaire, and that's the rule of thumb. It says if you invest at least 10% of everything you earn, you'll be a millionaire by the time you're 60. And I'll prove that to you. So here's 10%. Now you can always change this later if you guys want to, but we're going to start off with 10% right now because I just want to show you what happens here. I'm going to pretend like I didn't even get a raise. If I'd worked $12 an hour, and we know that you're going to get raises and you get more than that, but I just want to use this fill handle, copy it down, and pretend that we made $24,000 every year. But the key is that we were disciplined enough. See, amount invested? This formula just takes that amount and it multiplies it by this right here, 10%. So it just says you're disciplined enough to put away 10% of everything you earn. And now look what happens. This is the cell. This is the column that we care about, the balance after fees are deducted. So let's scroll down. $1.1 million would be your worth, your net worth, at the age of 60. Not too bad, is it? And that's only earning minimum wage. All right, so now, I wanted to hit undo because I wanted to show you something. If you just put $2,400 away during your 19th year after that first year of work, and you didn't even put in any more investments, see here, what does it grow to? $99,000. Isn't that amazing? That's what we call compound interest. What compound interest is, it's when you've earned some money. So you start off with 2,400 and then look at the end of the year, now it's up to 2,600. So that additional $240 that you earned in interest, now you're earning interest on that as well. So it keeps compounding and it grows faster and faster and faster because you're earning interest on each of the past year's interest. And so it just keeps growing faster and faster, and that's why it hits 99,000 so quick, well, in 40 years roughly. So, but to be accurate, you want to put in your numbers here. Now, so what I want you guys to do before I start talking about this, I want you to pause the video and do this. Put in here what you think you'll be earning. If you think maybe, let's say that you think you'll be getting raises, a certain raise, percentage raise every year. So you could do a little formula here that says equals, click on the cell above it, and then we can multiply it by 1.0. That means the 1 means 100% of the 24,000. So you're going to get when you get a raise, you're going to get the full 24,000, but then what percentage raise would you get? And I'm going to say convert it to a decimal, 0.0. Let's say you got a 3% raise every year. That's pretty good. So this formula says that's 3% added in. Then you'd be making 24,720 that year. Now, if I use this little fill handle and I copy that 3% raise down, right down, here we go. Let's see what we're making. $80,000. Not bad, huh? Not bad. Starting off at minimum wage and just getting a raise every year. So, I want you guys to go ahead and calculate. Oh, and by the way, you know what the pound signs mean? It just means the cell is too narrow, so double click and it'll auto fit. Or you can just click and drag. Okay. So now before I continue the video and talk about these three, I want you to pause the video and I want you to put in numbers that you think would be realistic on what you projected and what you think that you might be working in the future. And so maybe some of you might say something like, well, I'm only going to have a part-time job. I'm going to go to college and I'm just going to work part-time. So maybe I'll make $4,000 a year there, and maybe $5,000 here. Maybe $5,000 here. And then when I'm 22, let's see, I'll do one more year of $5,000. And then I get a job using the degree that I get. And maybe I get a job making $40,000, full-time job using the degree, so I'm making more than minimum wage. So now what would $40,000 be per hour? Halve the 40 becomes 20. Let's go back here. If this was 40,000, what does this need to be? What's the pay? That's right, it's just 20. So $20 an hour. So if you're making 20 bucks an hour, you're working full time, you're making about $40,000 a year. So maybe this is what yours is going to look like. And you decide, okay, then I'm going to get raises here, and you put in the raises. Well, how does that change things? Now we've got 1.8 million. And so you can see the key with compound interest is these early years really matter the most because you're earning interest on interest. And if you start investing, maybe you say, I was just talking to my parents, you want to run the analysis, and you say, my parents, they told me they didn't start investing until, so I'm going to copy the 0, until they were 30. That's when they actually started putting money away. Oops, and then it went away because I forgot. So let's go like this. I forgot those are all formula driven. So let's say I'm making $50,000 by the time I'm 30. So I'll type in 50, and now we've got that getting a raise. Now look, 1.03 million, but the other one was 1.8 million. So you can see it's a drastic difference. And that's if you're making $25 an hour by the time you're 30, and then you start putting away 10%. So the key is you start early. All right, so what I want you guys to do then is to go ahead and fill in what you think, and you're going to save that and then continue the video, and I'll talk about this next. Okay, so now I'm going to put it back, and I'm just going to put it back to the minimum wage. There we are, minimum wage with a 3% raise. Okay, here we go, 10%. This we're just going to leave that alone, and I'll explain. Well, I've already explained. We're just going to follow the rule of thumb. If you want to just play around with this and try like 2%, 5%, 8%, maybe 15%, you can play around with it. But these two are what I need to talk about now, is rate of return and the fees. So you'll see back on the Schoology page, I have a link here for Vanguard Exchange Traded Funds. I have that open already, so I'm going to click on it. And I just want to give you an example of what you would invest in, because now students always ask me, they go, okay, now that I've saved up $2,400, what do I invest it in to get that rate of 10% return? Because my bank account, if I just put it in my bank account, the savings account, they're only giving me less than 1%. So I can't, it's not growing very fast. I want to get 10%. And so my answer is, you're going to buy baskets of stocks. And we call those either mutual funds or ETFs, exchange traded funds. Right here, exchange traded funds. They combine the trading flexibility of a stock with the diversification and low cost of a mutual fund. So that really the only difference is mutual funds, when you place an order for a mutual fund, it trades at the very end of the day. It doesn't trade when you place the order. ETFs act more like a stock. Like if you were to buy a stock during the middle of the day, it trades it right then when you order it. And ETFs, they're just baskets of stocks, just like this. Same thing, baskets of stocks. But it trades when you trade it. And that's really the biggest difference. And then there's a few other like tax differences, but they're really the same thing. So I'm going to scroll down and look at their ETFs here listed. And I want to get down to the U.S. stock ETFs. So these are all U.S. stock market. Large cap, mid cap, and small cap. So I did a search here in Google, large cap versus mid cap. Just wanted to show you guys that a large cap company is a corporation that has, they say market capitalization, really it's like the value. If you multiply the number of shares of stock times the price, this would be the market capitalization. So 10 billion or more would be large cap. Those are the really big name companies that we all know. The mid cap companies would be between 2 and 10 billion, and then the small cap corporations are anything between 300 million and 2 billion. So when it says small cap, these are still big companies, because it can be up to the billion, and these might have 100 up to 1,000 employees possibly, just depending on the type of company it is. So these are pretty big companies, all three of these categories. But the small cap ones, as you're going to see here in a minute, you don't really recognize the names of these companies that much. Let's go to the small cap. So here we are. We're looking at small cap companies. And I'm going to look at now what I'm looking at right here, see this expense ratio? Okay. And the reason I'm showing you Vanguard's website is I have some stocks, some funds, some of these funds from Vanguard. And I've shopped around over the past years, many years, and Vanguard has always been consistently had the best expense ratio, meaning they're charging me the lowest fees in the industry compared to their competitors for bundling these stocks, and then I get to buy, when I buy a share of any of these, it's bundling and I'm buying multiple stocks, maybe hundreds of stocks. Well, let's go look at it and I'll show you. If I click on a growth, let's see here, small cap growth right here, 0.07, I like that one. I'm looking over here to look at their 10-year. Yeah, I like that one. VBK. I own some of this one. So I'm going to click on it so it shows me the results here. Okay, and where are we at here? Come on, it's still loading. Okay, now it's loaded. So I'm going to click on Portfolio and Management for this particular small cap growth. And I'm going to show you. There we go. It's a little glitchy here. Okay, Portfolio Holdings. And I want to show you the list of stocks that this company, has. Okay, so this particular VBK is the ticker symbol name for this Vanguard Small Cap Growth, and it has 588 different companies that it owns. And here's the most. It listed from the most down to the least as far as market share. So Coupa Software Incorporated, EPAM, Horizon Therapeutics, and so forth. So these are smaller companies that we don't see on the news every day, you don't hear about. But their market capitalization can be up to $3 billion, as you saw. So they're not small companies. These are pretty big companies. And so here's the point of buying funds like this, ETFs, exchange-traded funds, is that if any one of these companies were to go bankrupt, I'm okay with that, because maybe then one of the other companies that are a competitor to it will pick up those clients, those customers, and so their stock might increase as a result of the other company going out of business. And so I'm a little bit safer because I own a little bit of a bunch of companies, 588. And so it's safer than me just going into any one of these companies and going, okay, I'm just going to buy that $2,400 for the year that I saved up and just buy one company with it. Because if you buy all one company, it's much higher risk. So this is a good way to lower your risk, but yet you're still buying stocks which are typically in the past, historically, have given you over a 10% rate of return on average every year. And so that's why I'm showing you this. Now if we go back, and so I'm going to click on the Excel spreadsheet and show you, there's the 10%. So by buying the ETFs and buying stocks, they average 10% per year. Now, you might have 1 or 2 years where the market goes down and you only earn 1% or even have a negative. But the 10% is an average of any continuous 20-year period. And so if you look back on the history of the stock market, the United States stock market, any 10-year period, or 15, 20-year period chunk that's together, continuous, it's always averaged at least 10%. So that's where you want to put your money, is into these ETFs or mutual funds, because you're going to get a nice rate of return rather than just letting it sit in your bank account and only get a fraction of that. Now let's talk about these here, rate of return. Oh, excuse me, here's the rate of return. I was pointing to the wrong one. But anyway, that's what I was referring to, is the 10% rate of return. And again, that's looking over here. See, over 10 years or since inception. So we're going to look at, like the one that I was just showing you that I own. I own multiple of these, but that was one of them that I own, the VBK. Over the last 10 years, it's been 13.4 since inception. Let's see, that was 2004. 9.78. So any 20 years, so that's not even 20 years, let's see, that's 16 years. But by the time we hit 20 years, it's going to average out and it should be 10%. And that's what it's always been. So that's where I'm getting the rate of return, is by looking over here over long periods of time. Not just looking at 1 year. I want to look over long periods of time. Now, I just want to quickly show you a major one to see if you can look at, see if you can recognize some of these companies. Let's click on this one. It's a 4%. Portfolio management. And then we're going to click on portfolio holdings. They show the top 10 right here. Hey, you recognize Apple, Microsoft, Amazon, every single one of these. But I want to show you the total. And it looks like there's 269 companies in this particular stock. So if I bought VUG, this ticker symbol, then I'd be buying a little bit of every single one of these companies. Pretty cool. So that you recognize most of these. Nike, Costco, McDonald's, Netflix. Look at that. And so that's the beauty of buying these guys. Now, I just told you guys that this was a 4% rate. I'm going to let this guy, I'm going to go back to that page, ETFs, and show you that again. Ooh, there's small, mid. Let's pretend we're looking at this one here. Large cap, that one that I just looked at, VUG. It's 0.04% expense ratio. So now when I go back here, if I were going to buy that, let's say that I'm going to project 0.04, hit enter, and check it out. Look at the fees just went down. So this determines how much fees are being deducted from you every year. And that's when I said that I shopped around and I arrived at Vanguard funds because I like them traditionally. Historically, they've always been in the lowest category among all of the competitors, and they've had the lowest fees because look at the significance of this. Now watch when I hit undo and I put it back to the fee that maybe one of its competing funds offers. So I'm paying over, if I pay this fee over 60 years, it's only $7,578. You might say, oh, that's a lot, but it's over 40 years. Now I go back at the 0.67, look at that, $100,000 in fees. Even it's still it's not even 1%. It's less than 1%, but that little bit of a difference makes a difference. It's amazing. And so just wanted to point that out to you guys, and that's why I put this here, is because if you're going to go look at that website and look at funds that you might want to buy, and maybe you'll put in what you expected rate of return, you can put in the fee, and you kind of get a good estimate of what your balance would be if you were to buy that particular fund and put this amount of money in each year. All right. So what you're going to be doing then is once you put in your projections, you guys are going to email this to your teacher, either me or Miss Brandt, and that's how we're going to give you a grade for you doing this assignment. Is you're going to put in how much money you think you're going to be earning right here. You can modify these if you want based on a fund that you might find that you think is interesting that you'd want to buy. You could do an average because you might say, well, I'd want to buy different funds every year. And you'd say, maybe it averages instead of 0.4, if I bought a fund that had one of them is 0.07 and others 0.4, so maybe you put in 6 as like an average or something like that. That's fine. So fill in numbers here, which you project your earnings, and you can modify this or this. If you keep these the same, I'm fine with that 10% because that's just an industry. That's the average of the stock market. And keep this 10. I'd like you guys to keep that as 10 as well. Then you're going to save your file and attach this and email it to me or Miss Brandt, whoever your teacher is. Happy investing.